It sure might seem like an overwhelming effort to keep your finances in check, all the while keeping your expenses in check as well. Ever just wish that money came and went easily with no burden alongside it? Well, start your financial planning and master your money with these 10 tips that you'd never regret. Welcome back to Finance Professor. And before we jump into the video, don't forget to click that like, share, and subscribe button. Starting off our list with number 10, make both immediate and long-term goals. The pursuit of financial security does not come easy and requires constant juggling. Some of your objectives would be ones that you want to accomplish as soon as possible. Other objectives might not be completed for years or even decades, but they must be started as soon as possible. A wise first step to any financial planning is to compile a comprehensive list of all of your objectives. When you are certain of your goals, it's always simpler to plan a path of action. Short-term objectives are the ones to be met in the upcoming year or so. Create an emergency fund that can pay for your living expenses for at least 3 months. Limit the amount of new credit card charges to what you can afford to pay off in full each month. Make and stick to a budget. Pay off any outstanding credit card debt. For long-term objectives, start by putting aside at least 10% of your annual gross income for retirement. Save down for a down payment on a house and plan for the education of a child. Number 9. Create a budget. This is not a very easy subject. Agreed. However, setting up a budget is the one action that makes achieving all other financial objectives easily possible. A budget is a detailed assessment of all of your revenue, including your salary, as well as any potential side jobs or investment money. Laying everything out in front of you allows you to see where your money is going and make adjustments if necessary, if you're not already currently on track to reaching your goals. Running your existing cash flow through well-known 50-30-20 budgeting framework is one technique to analyze it. The objective of this strategy is to allocate 50% of your after-tax income to necessities, such as rent, mortgage, food, car payments, and other 30% necessary costs such as phone and streaming services, or nice-to-haves like eating out. The remaining 20% should go towards saving, including money for retirement, emergency funds, and a down payment on a home or even a new vehicle. To create and keep track of a budget, open an Excel or Google Docs spreadsheet. In addition, there are budgeting apps that you can connect your bank account to make it simpler to keep tabs on your spending in real time. Number 8. Create an emergency fund. Okay, you probably don't need convincing and convalescing to establish that money must be set aside for life's never-ending stream of financial unforeseen expenses. Setting a target for the amount of protection you want to build is the first step in creating an emergency fund. It's a good idea to have 3 months' worth of living expenses set aside in an emergency fund, and 6 months' worth is even better. The simplest method to do this is to start an emergency fund specific savings account with a bank or credit union. The temptation to use this money for purposes other than emergencies is introduced if you keep it in your regular checking account. The highest rates are often offered by online saving institutions. You can create an automatic transfer from your checking account to a high-yield online savings account. Refuse the debit card that online banks may provide you for even less spending temptation. Number 7. Pay off expensive credit card debts. These days, the interest rate assessed on outstanding credit card balances is referred to as insane. Banks frequently offer less than 1% interest on savers these days on savings account, yet the typical interest rate they charge credit card users with an outstanding amount is approaching 17%. If your credit is good and consistent, you can think about seeing if you can get a balance transfer offer from one card to another that will waive off any interest charges for the first few months. Number 6. Save for retirement. It's said that the moment to start saving was yesterday, even if you still have decades until retirement. You will need to put in more money to retire in good health the longer you put off taking this important goal seriously. There is no predetermined amount that you must save for retirement, but a good rule of thumb is to set aside a multiple of your pay at various ages. As you can see here, setting yourself up for success by establishing a retirement account balances that are 2 times your salary by the age of 35. The goal is to have 6 times your pay in retirement funds by the time you attain 50 and 10 times your salary by the time you attain 60. So ASAP, begin saving at least 10% of your gross income. Saving 15% more greatly is preferred though. If you put a savings aside until your 30s, you'll probably need to set aside 20% or more of your income to attain your retirement goal. If you're unable to reach 10% right away, make a plan to increase your contribution rate by at least 1 percentage point each year. Number 5. put a long-term focus on your retirement investments. The main determinant of how comfortable you'll be when it's time to get off the work treadmill is how much money you'll be able to accumulate for your retirement life, more like an afterlife. But you should also consider the strategies to invest the money in your retirement accounts. Determine how much of your retirement savings you put into the bonds and how much into equities. Stocks might be volatile at times, but historically speaking, over long periods, say 10 years or more, they have produced larger returns than bonds. As if this information needed to be emphasized right now. Your personal objectives, tolerance for risk, and time horizon, or the number of years you anticipate holding your investment, will all influence your personal best stock-bond combination. The well-known Vanguard creator and unwavering supporter of individual investors, Jack Bogle, offered the following straightforward guideline. Your age must be subtracted from 110. According to percent, that is how much you desire to keep in stocks. Number 4. Smart and efficient borrowings. Large-scale purchases for your lifestyle frequently require borrowing money. These range from the homes that you hope to purchase and automobiles that you drive to helping your kids with their college costs. Making financial stability a priority requires only taking out loans that are actually and absolutely necessary. And that can be challenging because lenders are more interested in informing you how much money you can borrow than anything else when you're trying to buy a house, a car, or even a college tuition. Nobody will make the suggestion that you borrow less while looking you in the eye. Frankly, lenders don't know or care how the loan that they're holding out to you will affect your capacity to achieve all of your other objectives. This is entirely a personal subject. To achieve your goal, you should constantly aim to borrow as little money as feasible. You'll have more money for other objectives if you borrow less. This is a general rule of thumb in this matter. Once you've established your borrowing limit budget, taking proactive steps to raise your credit score can help you secure the best terms. Number 3. Seizing opportunities while markets are at weak trends. Value stocks are now more affordable than they were when the stock market was at its top, making the current stock market dip an excellent time to invest in them. However, it is acceptable if you're to pass up some of the market chances if you're having serious financial problems and are unable to pay your normal expenditures. Prioritizing your needs and those of your family during difficult times is the key to managing your personal finances. Financial independence and peace will go hand in hand once you accomplish that. If your necessities are compromised, it's possible to break any personal financial rule that is primarily related to investing and saving. Number 2. Retirement saving techniques. From a financial perspective, the avalanche approach is the best choice. Under this method, every month you make the minimum payments due on all of your credit cards and then transfer additional funds to the one with the highest interest rate. You begin making additional payments to the card with the next highest interest rate once the balance on your card with the highest interest rate is paid off. On the other hand, if you use the snowball strategy, you want to send your additional monthly payments to the card with the lowest balance due. The appeal of having such a repayment strategy is the psychological boost it offers. By concentrating on the card with the lowest balance, you'll pay it off more quickly. If you require incentive, the sight of a card's balance dropping to 0 can be helpful. If not, the avalanche system will actually save. And number 1, never co-sign a loan. In the event that the borrower, your friend, relative, loved one, or whoever, misses payments, your credit score will be plummeted. The lender may pursue you for the debt, and it will probably endanger your debt relationship. Additionally, the bank doesn't trust the borrower to complete the payment if a cosigner is required. A bonus piece of advice for parents is to first determine if your child has exhausted all federal loan, grant, and scholarship opportunities before agreeing to co-sign for a private loan on their behalf. And with that though, we have come to the end of this video. Make sure you utilize these tips in your life, and also don't forget to like, share, and subscribe.